Most things that we want to achieve in life needs planning because planning provides direction for action. Doesn't the same holds true when it comes to our financial goals? Whether you want to buy a house, have a wedding plan, save for your kids' education, or want to live a fulfilling retirement, you need a roadmap to reach them on time. That's precisely where a financial planning might help. However, financial planning can feel like an abstract concept for many. So, to help us understand how to go about it, what processes to follow, and what to expect out of a financial plan, in this episode of One Step Ahead show by TSP Mutual Fund, we have with us today Mr. Tanwir Alam, an investment veteran with almost 3 decades of industry experience and certifications from renowned institutions like IMT Ghaziabad, Business School at Oxford University, and IMT Lausanne at Switzerland. Tanwir Alam, founder and CEO at Fincart Financial Planner, is an accomplished business leader who has served as a lead panel speaker with CNBC TV 18, Z Business, and ET Now. He is also a columnist with leading print media such as ET Wealth, Times of India, and Business Standard. Welcome to our show, Tanvir.
Thank you, Sma.
So, before we start our conversation today, a request to all our viewers here to share their questions in the comment section, and we shall get back to you at the earliest. So, Tanvir, we would want to start by knowing a little more about you and your wealth management journey. What is the story behind setting up Fincard?
In fact, this entire journey started much before I actually started my company. It was in one of those MDP program at Australia. I was introduced to the concept of having a purpose in life in a personal coaching session. In fact, it was at Stephen Covey, the famous book that we all read, Seven Habits of Highly Effective People, in that one of the coaching sessions. So yeah, so I started working on it, and while working in this industry, we all exposed to a lot of wrong selling that happens. So that was bothering me, what I could do. So and this training session that I'm talking about was way back in 2003 December. So when I actually discussed with my coach in person, he said you need to plan to ensure that your aspiration do not affect your family and your loved ones. So I actually started doing my own financial planning by then. And I had set a goal for 10 years so that I could accumulate a lot of money that will help me give me that financial freedom to do something which I want to, and also ensure that my family does not have to compromise on the quality of living. So, as a matter of fact, I actually quit my job uh, on my 40th birthday month only. So, as a part of a plan. So, it took me almost 10 years to actually plan this journey of starting this company. Okay. So, this is how the entire concept started. But when I actually started this company, there was already a lot of players who were doing physical brick and mortar, and they were robot advisory. So I thought, what should be our differentiating factor? So one of the key thing that came to me, most people are focused on selling a product. We thought we will be focused on providing a solution and helping people achieve their life goals. So the core purpose of the company is helping people achieve their life goals. And our mission is to make ethical, simple, qualified personal finance solution accessible to all India. And that's the FinCard dream.
Wow, that was an inspiring, story that you just mentioned. I mean, wonderfully planned. Also, like you mentioned as well. So Tanvir, as a financial planning expert or a personal finance expert, what kind of client profiles do you manage? Would you want to tell us a little bit about that? And also, how big is the team? How many investors as a whole do you all manage?
Very good question. In fact, when I actually started this journey, a lot of people thought that I will actually, given my expertise in finance, given my years of experience, I would be focused on managing the ultra HNI people in the country, and would be possibly looking at kind of a private banking setup. But I had my dream completely diametrically opposite. And the reason I did that was, I know that was a tough journey. I felt that the people at the corporate level, people like you and me who are working at corporate executive level, they are used to good quality services. And they don't like either uninformed or ill intent people coming and talking to them. And they want something which will make sense to the entire thing, because by being in the corporate world, we are used to certain way of dealing with things. So what we did, we actually focused on providing the solution to the corporate executives, and that was our target audience. And till today also, more than 95% of my client are close to from corporate executive field. Okay. And the number of family that we manage is 10,000 plus families we manage as of now. We started with a very humble beginning, a 350 square feet office, 5 people team member. Now I look at, I have got 4 offices, close to about 145, 50 people in the team. Uh, we are managing close to about 1,200 crores of assets. So I think, yeah, the journey has been good. But what is more uh, satisfying to me is that I've been able to create a product, create a services which actually is helping a segment of the people who do not have access to great quality financial advice.
Understood. I mean, from a 5 people team to a 140 plus members in the organization and serving more than 10,000 families, that's quite a journey. In fact, Tanvi, to tell you, at DSP, we also take financial wellness program as a very honest and a sincere effort from our end, and we have reached out to thousands of individuals across different organizations pan India. And when I conduct those sessions, a very common question that many people ask us is, we are already saving money for our financial goals. Why is it so important to then think about financial planning? What's so special about it? Also, they often, asks us that, they get confused between terminologies like a financial planner, a financial advisor. Could you tell us what exactly is financial planning all about? And what's the difference between a financial advisor, RIA, or a mutual fund distributor? That could be quite helpful for our audience.
Great. Very good question. In fact, let me share from a different perspective. To be very honest, if I look at our parents, our generation parents, they never did financial planning. And yet they provided us all with great quality education, and they lived a very good retired life, and they were happy. They have a very fulfilling life. But what has changed over the last few years, rather many years, at least a decade or 2 decades? The consumption boom has led to a situation where people are consuming more than what they're saving. The mushrooming of mall, easy access to loans and credits, making people live beyond the means. And they have a lot of aspiration also. My people of our earlier generation, our parents, have limited aspirations. But if you look at people like us or one down below, the aspiration levels are very, very high. So if you actually want to achieve a lot of your aspiration with the limited amount of means, you have to ensure that you use each and every naya paisa of yours in the right way. You don't have any scope of uh, uh, making a guess investment or investment by ad hoc way. You don't have a choice of actually allowing your money to sit on any fixed deposit, which is not giving you a very high post-tax return. So keeping those things in perspective, financial planning to in today's time has become a necessity and not just a fad or good to have. So this is what financial planning does. Now, see, financial planning basically is, to be very honest, most people believe financial planning is required for the rich people. It is not for the rich people. Planning is required for people who have got limited means but have got high aspiration, so that it can be planned, investment can be planned in such a way that it helps you to achieve your life goals, ensure that your life goals are protected when anything unforeseen incidents has happened. So this is from financial planning perspective. Now people get confused with financial advisor, and a financial advisor may not do financial planning. Okay, I may give you a financial advice which could be related to investment. It could be related to your business. It could be related to your fundraising in your business. It could be related to even providing you estate planning, trust services. These are all financial advice that people give. So financial planning advice is a much different ball game altogether, which may encompass financial planning, but financial planning is a very specialized art, which is involves around planning your in cash flow and investment to ensure that it gets invested in the right way. Now, coming back to the RI question, see, RI, let me take you back. So, RI was started with the concept of that there should not be any conflict of interest. A registered investment advisor would be giving only advice, will not help you execute your trade or a plan. Whereas a mutual fund distributor will be basically giving you incidental advice, and we would be giving you, we're helping you transact. And but unfortunately, over the period of time, this is the unforeseen consequences of actually putting things in place. Is that people correlate this RI as a cost saving mechanism. Honestly speaking, if I have to provide RIA, I'll be charging more. Okay, so because that uh, payment that typically RI people gets is delayed between 3 6 months, and many a time, because we had a scenario earlier where my payment was delayed even 9 months. Whereas in mutual fund distribution, when we do, the payment comes to me on a monthly basis, and I have a large team to manage. I have to ensure that cash flow funds their salary, everything. Hence, there is been a disconnect in the way people perceive RIA and what exactly it was meant to be.
Understood. So, while you talk about the role of advisors here, we also often come across this question: should I do it on my own, or should I go to a financial planner or an advisor? And today, there have been so many apps which, which can assist in financial planning. And you also mentioned about robo advisors, AI claiming that they can also help in financial planning. Do you think technology can replace the need of a human financial advisor, or is there a balance between tech and personal advice? Um, can we actually do it on our own, or at what tipping point do we need a professional advisor, and how can they add value to to my overall financial planning?
In fact, when I actually started this business, there were two kind of intermediary. One was a mutual fund distribution, or the physical with a physical brick and mortar. And then you also had complete robo advisory people like Scriptbox that time, Funds India, and all those people. But the challenge with, and we actually created something called numberless finance. Numberless finance, because we strongly believed that the fear of maths, as we people grow up, become the fear of finance. And we wanted to create something which was a complete no-brainer, and it was ask intuitive questions, and it could give you a financial plan. The only two number question were, what's your income and what's your expense? And I could give you a complete financial plan, which could tell you how much health insurance, how much term insurance should you have, if you're saving for children education, your vacation, retirement planning, everything could be given by that questions. Unfortunately, what happened, the average ticket size was so small that we would have to perpetually depend on a VC to fund our business, and a survival would have been at their mercy, which we did not want. So that is time we pivoted, and we actually launched India's first uh, online assisted virtual advisory platform model. And that virtual advisory basically ensured that we use technology as an enabler. The financial planning automation was done, online transaction was done, and you could track all your investment in one dashboard. So we use technology as an enabler, but put a human face to it to ensure that somebody was communicating to you in a language which you understand. Now, that was way back in 2013 when we started. It's been about 11 years. Now, we are reconsidering launching numberless finance because we feel that digital adoption has increased post COVID, and especially Gen Z people may want to use a DIY. But my there is a little hunch. Okay, now why are we doing that? Because we don't want to get caught in a Nokia or Kodak moment where we actually feel that we lost in the digital wave.
Yeah.
So we are launching DIY completely once again, and this time will be more AI enabled because a lot of information are available in the ecosystem, and we could draw those information and create a better quality product. Now, having said that, over the years, what has been my experience is that when people have smaller bets, they want to invest few thousand rupees SIP, they would want to go to a DIY platform. But when the stake increases and it goes to say 10, 15, 20, 25, 30, 40, 50 lakh a crore, they would want some kind of validation. And this is until now holding true. Will it hold the same in the future? It's hard to comment at this point of time. But I yes, technology will play a very critical role in shaping this entire industry, how this entire advice is delivered to the end user.
Right. So it really appears to me that you have always, maintained a balance between technology and personal advisory, and that probably is a way to go. It seems, given the fact that so many people are, comfortable with a technology-enabled platform where they can probably also reach out to their advisor and, get the advice vetted. So I think that's a wonderful way of advisory. We would want to know more about the processes that you follow, Tanvir. What kind of funds do you recommend to your clients, and how do you begin their financial planning journey?
Okay, very interesting question. See, when I actually started and when I was on my notice period, so my notice period was 3 months, and thereafter I was on a garden leave for another 3 months. During that garden leave period, what I did, I actually wrote down the entire process and SOP. So we've actually hard coded a standard operating procedure. Now the intent was two, because this makes it scalable. This ensures that you have quality advice to all class of people, because my objective was to help people who have got limited money, not for people who have got tons of money. Okay. So ensuring that quality advice gets delivered, we have written the SOP. So before I go to fund selection, I will tell you what exactly the entire financial planning template covers. So we have coined the entire process of knowing a financial plan was acronym by the word drawn. Okay, your what are your dreams, and R is your reality check. Basically, where do you stand and how far are you from goals? A uses the available resource. W is the way forward, which is the financial plan. And N is navigation. We feel that financial plan is not a one-time exercise. It has to be navigated because your personal situation will change, the funds recommended will change, and hence it has to be monitored and navigated at a regular interval to ensure that the end user or client meets its goal. Now, what does the financial plan template cover? Again, we have acronymed by the word ERGRE to sound similar in both ways. E talks about the emergency fund. Before we start any investment, we ensure that there should be an emergency fund for him. Now, emergency fund may not be only for bad reason. It will be good reason. Maybe there's a wedding in the family and you need to have extra money that month. So you don't have to break your long-term investment. You can pick up from an emergency fund. Okay. So RS stands for risk protection, which covers your health insurance, term insurance, and if you have a family history of any critical illness, so it will be like you can have critical illness. And we also recommend even permanent and partial disability. But those last two insurances are good to have, not need to have. Health and term are necessary, one must compulsory have. So these two processes ensures that you protect your hard-earned money. Because not having a health insurance, and now most corporate executives only depend on their company health insurance. Most Indian families are one medical bill away from poverty. And that's in the importance of health insurance. So this is about the protecting the money. G stands for goal planning. We plan for each goal, whether it's short-term goal, medium-term goal, long-term goals. The recommendation of a product is based on the goals, not the product other way around. If it's a short-term goals, it will be ensure that you have to meet with a product that suits the requirement. The long-term goal is met by equity funds, a long-term fund, which is good for long-term. R is retirement planning. Why we have kept it separately? Because this is one of the most important and a certain goal for everybody. And behaviorally, anything that is very far away tends to get ignored. In fact, there's a beautiful study which happens. Uh, it was in Mumbai local train. People used to die by accident. So when they were doing survey, they said ki the driver used to say ki when I'm honking, these people are standing, they're committing suicide. But when they investigated the case, they realized that people were crossing with vegetable, fruits, vegetable, normal groceries, and also liquor. So the conclusion was, if we had to commit suicide, why wouldn't have liquor and commit suicide? Okay. So then behavioral scientists and psychologists were called. So anything, the train used to be far, a normal human mind would judge that he would cross the train line. But the train, which is far, he has an ability he can manage. But the train approaches so fast that when he sees very close to him, his brain freezes to act. And that is why he meets an accident. So retirement planning has a similar anecdote. Because it's very far, it's most ignored. And it's very unfortunate that all the surveys suggest that 7 out of 10 people will have to depend on their children for retirement. And that is why we've specifically kept retirement as a separate goal. So these two helps you achieve your life goals. And the final E is estate planning. Now, estate planning ensures that you transfer your hard-earned money to your loved ones in a seamless manner. Now, given the fact that we are now living in a nuclear family, when we do investments, when a respective spouse is the nominee, but we go on holiday together, we go on movies together. God forbid any accident happens, our kids, our children, our loved ones will not know our investment also. So I think that is why that E is important. So the entire concept of this financial planning is you protect your hard-earned money, grow them, and then seamlessly transfer to your loved ones.
Wow. So I was thinking that financial planning was all about investing. It's way beyond that. What you said, it also means managing your emergency fund, creating a protection plan for yourself, both in terms of health and life, like you mentioned. Also, retirement planning is an important aspect, and estate planning is also being covered. I'm sure a lot of us are not aware that so many things are being covered when we plan to do financial planning, and it's not just about investing. That brings me to my next question. Is there a right time to start financial planning? And how do you recommend younger clients to begin? How does that differ from those who are closer to retirement?
See, I would say the sooner you start, the better. In fact, younger audience, especially when you're not married, I would use an anecdote of cricket power play. So it's like a power play for you, because before you get married, you have responsibilities, you have families. The initial earning years could be utilized for saving aggressively. And we have seen that the power of compounding plays phenomenally well if you start investing at an early stage. And when you get married and you have financial responsibilities, your ability to save, your marginal propensity to save reduces. Okay. And hence, it is better that you start inculcating that habit at an early stage. So I would say one should start from the day he thinks it's important to him. It should not be left to chance. Okay. For people who are just starting, I would say if you start early, you just can't imagine the power of compounding. Okay, I was just trying to evaluate few funds who have completed 30 years almost from 1993 onwards. And some of the funds, if you're invested just 10,000 rupees SIP per month, that sum over the last 30 years, in 1 year, you would say in 1.2 lakh rupees, in 10 year, 12 lakh, in 30 year, 36 lakhs. This 36 lakh rupees today, after 30 years, would have been anywhere between close to about 4 to even some fund, even 7, 8 crores. Okay. So imagine you started at about 20, 20, 23, 24, 25, and today you're at 55. You have a corpus of 5, 6, 7 crores by just doing 10,000 rupees per month. So I think this would give you a lot of financial freedom. And to be very honest, a lot of female take sabbatical for family reason. A lot of corporate executive gets burnout towards their later part of their 40s or early part of 40s because of high intensity working environment, and they want to go slow, or they want to go slow because of family reason. All this starting early will ensure that you're able to do that. Now, for somebody who's already late, there's nothing called late. If you're closer to retirement, you should not get worried. You should then approach a specialist. The reason being, you will not need all the money when you retire. So what we do in that scenario, we run what is called a bucket strategy. We plan your initial few years of post-retirement in a different way, the next few years, and the last decade. So in a way, we break out your retirement journey in a way, in a staggered manner. And when you use buckets investment strategy to ensure that even if you're starting a bit late, you don't have to depend on somebody else for your retirement.
Right. So that was quite enlightening, Tanvir. For all the audience here, before we move on to the next set of questions with Tanvir, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. Tanvir, coming back to you, you mentioned about covering both short-term and long-term financial goals as you take onto the journey of financial planning. Can you give us some examples and tell us, how do you actually plan such goals from real life? How can people associate with that kind of advisory?
Okay, so let me take a normal family, say a young mid-level family with younger children. So nuclear family, what are the general goals that they have? They want to actually buy a house. They would want to change a car every few years. They want to go on a vacation on a regular basis, domestic and international. They want to save for children education. They wish to ensure that they have a good corpus when they retire. There are five most common goals that I have. Now, so children education retirement are most often a long distance goal, unless that gentleman comes a bit late to us. So what happens for in our financial planning, when we select a product, what we did some back testing and what we call is value at risk. Okay. So we back tested each and every mutual fund product, saying at what point of time horizon, if you invest, you will destroy capital. So we realized that if you invest in an equity fund, if you invest for a period of 1 year, there is a 60% probability of making money. If you invest for a period of about 3 years, the probability goes to about 75%. On a 5 year basis, it increases to 88. On a 10-year basis, almost 100%. I can't say 100% in finance, 99% of the time, you will never lose capital. So what happened? The volatility risk mitigates over a long-term period. So to fund long-term goals, which are 7 years and above, we use equity mutual fund. For funding a medium-term goal between 4 and 7 years, we use hybrid category fund, preferably balanced advantage fund or a equity savings fund, depending upon the risk profile of a client. And for short-term goals, we look at debt mutual fund or any other alternative fixed income product, because today the tax arbitrage in fixed income has gone, I mean, debt mutual fund has gone away. So hence you are almost at par with any other fixed income product also. So you can utilize those products for funding your goals. So this is how we segregate. Now, within each category, we have a matrix. So we are conservative, moderate, and aggressive profile, and the time horizon. So we have a matrix, and we have each matrix has a fund selected in that. Each category of fund has three fund selections. So when the system produces a financial plan, the advisors can choose only from that three category only. So to ensure that the quality advice goes to the end user, we have hard coded this matrix and with the fund that gets selected centrally. And the advisor will have to recommend within that basket for the goals that is chosen.
Right. And do you give a lot of importance to risk profiling for the clients as well? And how do you go about that?
See, risk profiling, especially for people who are new to investment, is very, very important. We have to take into account the fact that majority of the people are migrating from fixed deposit. And if they're migrating from fixed deposit, initially understanding their biases towards risk is very important. Now, if he is a person who's scared of investing, now behaviorally, very interesting, there's a part of neuroscience. Uh, Fear is such a big emotion. Okay, behaviorally, the fear of loss of money gets processed in the same part of brain that deals with death and mortality. That strong is the fear. So hence, risk profiling becomes important at this stage. Now, as he gets comfortable with investing, okay, and especially for people who have come in the last few years, and we've seen the equity market going one way post COVID, his risk profile has gone away very aggressive. So now those categories will tone down. Okay, life is not going to be only upside. There may be volatility. So if you ensure balance, then looking at the return, you say, why don't you put all my money in equity? So this is the other spectrum of risk management, not only profiling and getting him to invest in mutual fund, other risk category, but also to tone his risk down. Okay, you have to balance it. Don't go take this equity return for granted.
Right. So the idea of financial planning seems to be quite fulfilling and yet could be quite overwhelming, especially for someone with no prior experience, it seems. What preparation do you suggest they should take before meeting a financial planner? What kind of questions they should ask, what kind of documentations or filing, etc., they should consider? If you can enlighten us with that thought.
Very good questions. So we need only three set of information. Okay. One is you should clearly articulate what your goals are, what's your dreams are, what do you want to achieve with this money, and why I strongly believe in providing solution. And I'll use an anecdote later on. Two is I would want to know what your income and expenses are. And three, if you're already existing investment, what are your assets and what are your liabilities? These three information, if you come ready with, then everything will get sorted out in one simple meeting. It's not very overwhelming. People who do not have structure create confusion in the mind of people. If you have laid down a very well laid out financial planning structure, it enables both the client and our internal advisors to add method to the madness. And hence it becomes simple. It's not a very rocket science. So
Right.
anecdotally, why I'm talking about solution, I'll tell you. See, ibugesic is a medicine which is used for treating severe body ache and fever. A patient having dengue will have a similar symptom. But God forbid, if a patient having a dengue patient is administered ibugesic, most likely will die. The same symptom, same medicine, and yet two different outcomes. So because of ibugesic, the platelet count will rapidly drop and he'll bleed to death. So it is not the product that destroys capital. Equity market has never destroyed capital. It is the ill application of that product that has destroyed capital. So hence, when you come with a financial plan and the right application of the product happens, we've never had bad experience of people. Okay. So that is one of our reason for being successful. And when we wanted to go for a fundraise to build spend more on technology, you'll be surprised that it is our clients who invested in our equity.
Right.
Go to any VC for raising money.
Okay. Okay. So that brings me to the next question, Tanvir. You highlighted the fact that it has to be the right amalgamation of products being suggested to clients based on their financial goals, and of course, what kind of risk profile they have, etc. How how often should they evaluate the financial plan being created, and when should they make changes? If you can help us understand that.
See, evaluation should be done at least once a quarter. Changes will happen either annually when your financial situation change, you have gone for an increment, you have changed job and you've get a substantial hike in your salary, you have got say a bonus, or you've got ESOP option, or there's an addition in the family. There are many things that will happen. So financial planning is not a one-time exercise. It's an exercise that it's like a Google map. You've decided you want to go from here to there, and the road route might change. Your goal will never change, but the approach to that goal might change. And that is why you need a quarterly review and you need an annual revisit of the financial plan. So this is why you have to navigate. So if you recall the drawn part, N was navigation. This navigation has to be done at a regular interval.
So as and when you do this, evaluation, and if you come across a position where, your investor has surplus money, uh, can 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 they also take tactical investment decisions in between, which may not be related to the core financial plan? Or do you advise them that, they should put this money in a savings account or a fixed deposit till the time it's not been utilized? What do you do in such situation?
So without sounding it very complex for the end user, when we do goal-based investing, automatically it creates an asset allocation. So what we do, we create that forms a part of your strategy asset allocation. And we use some product for tactical asset allocation, depending upon the scenario. For example, about 6-8 months back, we completely lock stock barrel booked from small and mid cap. Okay. And we are now focusing more on the large cap oriented product because we feel that in the last 12 to 18 months, it is the high growth and high quality company that is not run up. Okay, even the low quality and low growth company ran up very significantly. And you seeing in the SME IPO also, I mean, a Yamaha, yeah, a showroom with about 8 employees getting oversubscribed 400 times, a 1200 crore IPO, 12 crore IPO getting money of 4800 crores. I mean, this is obscene. We have not seen earlier anyway. So these are level of exuberance which happens. And when this time comes, you will see every stock, Tom, Dick, and Harry stock going up. But what has happened over the last 18 months is the high quality and high growth that has not gone up. So what we are doing now, we have navigated the portfolio to high growth and high quality portfolios.
Right. This conversation is definitely getting interesting. But before we know more from Tanvir, for all our audience here, I'm sure as you are listening to this conversation, you might have a lot of questions coming in your mind. Do share the questions in the comments section and we shall get back to you at the earliest. Coming back to you, Tanvir, many people think that they need a significant amount of money to even consider starting a financial planning. Is that true? And how do you suggest someone with a smaller budget, with a limited budget, to start their financial planning journey? Also, how much does a financial planning cost?
See, financial planning should start with any amount. Okay, your monthly surplus is something that you should be investing on a regular basis. Now, don't get overwhelmed with the fact that your financial planning has so many investment to do and you need a larger sum. A good financial planner will gradually handhold you to invest in a step fund. Maybe he'll say, okay, we cannot fund all your goals at this point of time. You start with A, B, C, D, and keep moving up. Okay. So financial planning can be done with any amount, any surplus. Okay. It does not necessarily require a big amount of money, and that's a big myth. Okay. And truly, a good quality advisor will ensure. See, we don't, as a financial planner, we will not have a magic wand that I'll fulfill all your goals. But I will have a process to fulfilling all your goals by allocating money in a step one. So if you have, suppose hypothetically assume you need a 1 lakh minimum surplus for fulfilling all your goals. But today you have only 25,000. We might ask you to prioritize this goal. Which one is more important? Let's start with that. And we go in that journey, because what we have realized, people also grow up in their life. Their earning will grow up as they move up the career, and hence they will have higher amount of money that will be available to them for investment. So I think financial planning can be done with any amount. Okay, and it should not be very overwhelming for people. It's very simple. And the follow-up question you said is
On the cost of
okay.
financial planning?
Uh, we there are two kind of people. RI, a financial planner, who will draw a financial plan, but will not suggest are not mutual fund distributors. They will charge fee. But what we are a mutual fund distributor, our advice is what comes under incidental advice. We do incidental advice in the form of financial planning, and hence we do not charge any fee for that.
Right. Also, Tanvir, recently in the last budget, we have seen so many changes in the taxation structure of asset classes. Now, when you initially have, planned the structure, the financial plan for your clients, you might have considered certain, funds, and if those taxation structure changes come, how do you handle the impact of these changes in taxation? And can that alter future plans? Should investors really worry about these changes?
So yeah, we take into account those investments. Now, when so in fact, a very interesting study happened with us. The life example I'm talking about. There's a client who's been investing me for with about 10 years, and he's done reasonably well. He's done very well in his life. Okay, so his investment has grown rapidly. So it was a zero cost ULIP we had recommended way back in 2000, about 16, 17, when ULIP was not taxable. He was investing, that was a part of a tactical allocation. Now, why I'll tell you, because the money that get invested, entire return would have been tax free. Now, uh, tactical allocation, when I switch from debt to equity or equity to debt, large cap to mid cap to small cap, in mutual fund, all comes in short term and long term capital gains. But in that product, it was not taxable. Okay. Now, the question will come, most people feel that the ULIP would be high expense ratio. So this is where the quality advisor comes into play. We picked up a ULIP which had a lower expense ratio than a mutual fund. And how was that possible? See, ULIP has 4 expense ratios. Premium allocation charge, it was like an entry load in mutual fund. Policy administration, fund management expenses, and the insurance that they provide, that mortality expense. The product that we picked up had zero premium allocation, zero policy administration. The fund management was capped at 1.35%. It was like a direct mutual fund cost. And 10-time insurance mortality was there. Now, this guy invested way back. Now, all the good quality insurance product we had picked and found the loophole, government eventually taxed them. And ULIP now is become taxable. Now, this particular guy's investment in that ULIP has become 5 crores. Now, if I take that investment out, because it's completed 5-year period, I can take out the investment and reinvest. But when I reinvest, his tax advantage goes away. And whatever instrument I invest in will apply for taxation. Okay, whether it's equity in India, in equity mutual fund will tax. If I go for ULIP, any amount above 2.45 lakh rupees gets taxable. So it's not meaningful now. So we have not disturbed that investment in his portfolio right now because it doesn't need the money. Okay, so this is how you will have to manage taxation. Taxation, see, is not under your control. Government will change. What is under your control is the way you manage your portfolio, and that should be navigated to the best possible way so that tax is optimized. See, cannot be eliminated. What we can do is you can optimize tax.
Right. So just like the worry on taxation, as I take a lot of these sessions with young corporate audience, another very common and interesting question that comes is, should we try, financial products like cryptocurrencies or FNO trading or intraday trading? It seems that a lot of these investors look for instant gratification. What's your thought on those products? Can those also be a part of the overall financial planning?
Yes, I think a very, very interesting question. And see, greed and fear are two very strong emotions that play an investment. Now, I play a small game with you, Sumana, if you're okay with that. Okay.
Sure, sure.
So you have to answer this in 5 seconds.
Okay.
Okay. The price of chocolate and bubble gum put together is 110 rupees. Chocolate is 100 rupees more than bubble gum. How much do they cost individually? So your time starts now. 5.
110.
110, right? If you look at 110, the difference is 90, not 100. I
Oh,
said chocolate,
yes, of course.
right?
Yeah, so it's
So this is the reason why people do not make money while trading. And I'll tell you why. Human brain is uh, just weighs about 2% of the body weight, but consumes 20% energy and oxygen to run the body. It is lazy by nature. Okay. So there are two parts of the brain. One is the reflexive part of the brain, sorry, and the other is the reflective part of the brain. Okay. Brain being lazy will try to give you a gut feel reply, like you did 110. When he finds wrong and he goes back and say, oh, sorry, let me calculate again. He'll calculate 105 and 5. Okay, the difference is 100. Okay. So when the stock market passes through a extreme volatility and a bad chance, most people do the blunder of exiting at the wrong time and investing at the peak. Okay, because you are using emotion to invest. Okay, and that is why 90% of the people, in fact, more. I was listening to people like the people who may both their soul rest in peace. I was looking to Mr. Parag Parekh. He says, I'm a stockbroker, and yet I don't have to pay any brokerage charges. I do not trade. Mr. Rakesh Junjunwala is saying, if 10 lakh people try to trade and make money, 9 lakh, 99,000, 95,000 people will not make money. Okay. So the question is, because of this, the way we have wired in our brain, we will not. Yes, instant gratification or the greed will take you there. That is why most people have lost money in cryptocurrency. Okay, so anything that lacks rational, I'm not in for investment. See, I'm a finance guy. Anything I could put a value to it by rational means, I should be investing there. Uh, I may be a wrong guy. My views may be biased, but I'm not invested in crypto because that's something which I can't value. But if you have a strong urge to invest in such product also, it should be like a pickle in your thali. You should invest in such a quantity that it should not disturb your life. Any investment that you don't understand, you should invest in such a proportion that it does not push you into any financial trouble. That's what be my 2 cents advice on this.
Absolutely, Tanveer. In fact, you gave us a lot of reasons to believe that financial planning can make us better investors. However, one of the hardest parts of financial planning could be to stick to the plan. What are the most common mistakes that you have come across when you were dealing with your investors? Can you share some examples from there? Also, how do you help those clients to remain disciplined, especially when life throws unexpected expenses or temptations towards their way?
Okay. So we are not worried about life unforeseen trouble when we are planning investment because that's factored in the financial plan. What is worrying, and when we onboarding client, we make it very clear, is consistency. And I will tell you, consistency is one of the most underrated virtues of anything in life. Whether you are doing a financial planning or you're going for gymming, success of your business, success of any of your endeavor, consistency plays a very, very critical role. Okay. Now, let me give you a perspective there. Just by taking a gym membership or going to gym once in a while, I will not get fit. Financial planning is just a starting point. It's a great start to your financial journey. Living by the financial plan, consistently following the good quality advice will ensure that you have a strong financial strength and financial endurance as you move up in life. And perhaps this is the one most common mistake which people do is by discontinuing investment or stopping their financial plan or not continuing with that. I think this is one of the biggest concern that I would have for people who start financial planning and don't follow it through for years to come.
Right. Tanveer, thanks so much for joining us today and helping us demystify this process of financial planning. And I'm sure our viewers would have benefited from your advice and expertise that you had shared. To all our viewers here, if you need help managing your money, please click the link in the YouTube stream and we will contact you ASAP. And yes, don't forget to leave your feedback about this conversation. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.